Hi students. Well, our video today, continuing with long-term liabilities, is a look at a long-term note payable. Now this is not a major topic in your course because you'll notice your major topic seems to be bonds payable. However, it's another type of long-term debt which is actually very heavily used by most companies because most companies are not big enough. The majority by number are not big enough to issue bonds, so they borrow money from the bank. Now, a note payable is just, the idea is you as a company are signing a promissory note, which is you promise to pay. That's all it is. So it could be a bank loan, a car loan, and we're going to look at one example with an interest accrual today. So let's look at this note. We're going to borrow $20,000. We're paying 8% interest, and we're going to make payments on this. We're going to make yearly payments, and by 3 years, after 3 years, it's going to be repaid. So note again, our payments are going to include both the interest that we have to pay on the money we owe and an amount that reduces the principal of the note. So you would need a financial calculator or Excel to calculate the payment for this note. And I'm just going to show you how this works. So on my financial calculator, and again, this could be Excel, and you can try it on Excel if you like, you'll get the same number. The present value is 20. Present value meaning the amount we borrowed and we owe 20,000 today. The interest per year is 8%. We have 3 payments to make, and the future value, the amount we owe after the 3 payments, is 0 because the payments are paying off the note. So I mean, this could be 60 payments and it could represent a car loan, right? Where you borrow, let's say $40,000 to buy a car and you have 60 payments of such and such an amount. And you could do the same table and pretty much the same way, but this is a lot simpler because we only have 3 payments. Now, I calculated this on my calculator, and there's the payment highlighted. So let's go to our amortization table and make sure this works. So here's our payment, and our payment is the same every time. We start with $20,000 owing, and just like before, in many videos and throughout your different modules, you've seen that to calculate interest, we're going to take the balance, we're going to multiply by our interest rate of this time 8%, and that gives us $1,600 of interest for a year. So we paid $77.60, interest is only $1,600. This means that the balance, the 61, almost 61, is going to reduce the amount of our note. So now we only owe 13, and that's after the first payment is made. So we're going to make 2 more payments, and on my amortization schedule, I'm just going to copy down that line because it's all based on formulas, and I should get to 0. And we do. Okay, so the second line is the 13,839 times 8%. The rest for principal, giving an even lower balance, and then the final interest for the year. Okay, so that's pretty basic, isn't it? You've already looked at bonds probably, so this should be fairly easy for you. However, we do have payments on August 31, and from August 31 to December 31, our year end is 4 months. So once again, we must accrue our interest expense for those 4 months because interest again is a charge for money that you use over time. The time being 4 months, we have to charge ourselves interest expense for that period. We can't put it all into year 2. Okay, so over here, I've calculated, or I'm about to calculate, how much that is. So note that Again, August 31 to December 31 is 4 months, and I'm rounding to the nearest month here out of convenience. if you were at a bank, if you were banking, they would charge you by the day. So 20,000 times 8% times 4 months divided by 12 months is going to give us our amount of interest that we owe. Remember, we're not paying it on December 31. We're just accruing it as a year-end adjustment saying we owe the money. So I'm going to take 20,000 times 8% times 4 months divided by 12. And there it is, 533.33. So that is our interest payable. Now I'm just going to round this to the nearest dollar just to keep our journal entries a little bit easier here. You could, in real life, you would have to put in the pennies. So the interest expense that we just calculated is a payable, and when we do pay a payment on August 31, we're going to pay off that payable as well. So my interest expense is here, and interest payable is the credit. So we're sitting there with an interest payable, and I just want to remind you that because this is an adjusting entry, we have one income statement account, interest expense, and one balance sheet account, interest payable. The interest expense is going to be closed out to income summary or retained earnings. It's part of your profit or loss for the year. Interest payable is a balance sheet account, and this is a current liability in this case because we're going to pay off that payable within a year. So let's look at what happens then on August 31. Okay, so August 31, year 2. Now, we have more interest expense. And we're going to pay off our interest payable. So remember, that's a liability, and we're going to pay it off with a debit. And we're going to make our payment as well. We're going to make our cash payment, and as well, the balance of our note payable is going to go down, right? So remember, this is a liability. Your note payable is a credit. It's going to go down with the debit. So notes payable will be a debit, and we're going to pay money. So there's our cash credit. Now, I know the cash credit. It's our standard payment. So there's our cash credit. And I know my interest payable because I just did it up here. So here's my interest payable, paying it off. So the question is, what is the new interest amount? And this is the interest that goes from December 31 to August 31. So here's how I've done it over here. Notice that interest for the full period is $1,600. That's a year of interest. So here's my year, and here's the 533 that I already, what happened there? Anyway, 533 that I already accrued. So we say, hey, what's the difference? Well, the difference is the 1,600 minus the 533, and that's, I'm going to round that off to 67. Okay, so that is the interest that I'm going to incur this time. Now again, I think I'm just going to round these to the nearest dollar just to keep life simple for us. So how much is that new interest? It's over here. It's 1067. It's the rest of the interest for the year. So it goes here. And now we can say, well, how much did the amount owing on the note go down? Well, if I go to my table That's how much it went down. So there's the principal reduction for the year. And does this look right? Does your journal entry look right? Well, debits should equal credits, so let's just check. See if we did this right. Okay, if I round that off, I have $77.61 in debits, same amount as my payment, rounded anyway. So there is our August 31 amount and our journal entry. Now, you'll notice that that was August 31, year 2. We have to do a December 31, year 2 adjustment, an August 31, year 3 payment, December 31, year 3 adjustment, and an August 31, year 4 payment. The nice thing is the account titles are going to be the same. So, in fact, if you were doing this full question yourself, we'd say, okay, let's do December 31 interest accrual. And then we say, oh, okay, there's our year 3 payment. And then we would do this again. And we'd say, all right, let's do our December 31 interest accrual and our year 4 payment. Now let's look at this. We have the numbers here. All we need to do is the exact same thing that we did in this section to calculate our interest expense and interest payable to December 31, except when we do the next year, here we're using the next line in the table. So this first time it was 20,000 times 8% times 4/12 of a year, but now it's not 20,000 anymore. It's this number. It's the new balance owing. And I'm just going to copy this in and it should work. So the new balance owing times 8% times 4/12 is 369. So I've got 369 interest expense and 369 payable. Now what's the difference? Well, let's look at the table again. Our total interest expense for that second year of the note is $1107.15. So I'm going to take that number. There it is. And I'm going to subtract the interest we already accrued. Now just over here we accrued $369. The difference between the two, sorry. The difference between the two, $738. So, if that was a little confusing, you can replay that portion of the video and just check where we got those numbers. This is the full interest less the amount we accrued on December 31, and the difference, $738. So this lets us build our August 31 year 3 journal entry. Our interest expense, our new interest for 8 months is that amount. Our interest payable is what we have to pay off. Our cash is still our payment. Our payments are the same every year. Now, how much did our note be repaid for? Well, the note repayment here was $66.53.52. So that's how much our note went down. So I'm going to put that in. And what I'd like you to notice is that we're just picking up numbers from our amortization table. if you do an amortization table, this is all going to work great. Now let's just check our debits and credits. When you're doing an assignment, this is a good idea. If it's a little bit complicated and you're not sure if you got it right, just make sure your debits equal your credits on your journal entry. That can go a long way. Now we're off a nickel, and I would say that's just from rounding here and rounding there. So if I round these off, and round that off, there we have it. 77.61 in debits, 77.61 in credits. So if you're doing this and you're allowed to round off to the nearest dollar, it does make life a little bit easier. If you can't, though, just watch the pennies all the time. And probably the reason this didn't work is I used a couple of numbers rounding and a couple not. So it was off a nickel. But basically, if you used dollars and cents all the time, it would work. Now, notice that doing our calculations for the second year of the note was pretty easy. We just did the same thing we did in the first year. So this note would be finished off the same way. You would take your balance here, 71.85 times 8% times 4/12 a year, and that would be your interest expense and payable. And then you would construct your final payment the same way that we just did the other two. So I'm going to let you do that because I think that would be good practice for you. And your debits should equal your credits, and at the end your note should be 0 and repaid. So that's it for today's video.